Imagine checking your investment portfolio and seeing it grow by 18%, while your friend Eric, who sticks to traditional index funds, sees just 10% growth. That's what happened to me when I started expanding beyond the conventional investment advice everyone follows. We've all heard it: just buy VOO or SCHD and hold on to them forever. But what if I told you there are ETFs out there that might potentially double the returns of these popular options over the long term, if you're willing to accept some additional volatility? I still remember reviewing my quarterly statement and realizing my diversified ETF approach had outpaced the S&P 500 by 8% during that period. Today, I want to share the specific ETFs that could help you achieve similar results. In this video, I'll show you and Eric 6 compelling ETFs that don't get enough attention. Each of these funds targets specific growth sectors with strong potential. Stick around until the end, where I'll reveal my top pick, which has seen an impressive 97% return over the past 5 years while flying under most investors' radar. I'll also explain how to balance these funds for better growth potential while keeping your risk in check. My favorite ETF could enhance your investment strategy. It's been a key part of my own portfolio that many financial advisors rarely discuss. Before we explore these 6 funds, let's discuss why this approach might work better than traditional strategies. Many investors default to broad market ETFs that buy everything, great companies alongside mediocre ones. While funds like VOO and SCHD provide stability and solid returns, they may miss opportunities in focused growth sectors. The strategy I'm sharing targets specific trends, technologies, and business models with more substantial growth potential. These specialized ETFs give you exposure to emerging markets and innovative approaches that typical index funds can't match. They aim for higher growth while maintaining the liquidity and simplicity of ETF investing. Now, let's examine these 6 exceptional ETFs that could boost your portfolio's performance. I've thoroughly researched each one, evaluating their holdings, historical performance, management approach, and growth prospects. Our foundation begins with what I call the innovation mothership. This actively managed ETF has an expense ratio of 0.75% and focuses specifically on disruptive innovation across multiple sectors. What makes ARKK distinctive is its concentrated investment in companies pioneering breakthrough technologies in genomics, autonomous systems, robotics, and fintech. Unlike passive index funds, portfolio manager Cathie Wood and her team actively research emerging technologies, positioning the fund to capitalize on transformative trends. ARKK's notable holdings include companies like Tesla, Roku, and Zoom, businesses that are fundamentally changing their industries. The positions in genomic medicine are particularly promising, with several companies approaching significant FDA approval milestones. While ARKK did experience exceptional performance during 2020 with a 152% return, it's important to note that it has also seen significant volatility, including a substantial drawdown in 2021 to 2022. This illustrates both the potential upside and risks of thematic investing. The fund currently yields about 0.3% as it prioritizes growth over income. Now, let's move to our next selection, which targets another powerful growth trend: Global X Cloud Computing ETF, with ticker symbol CLOU. This ETF provides focused exposure to the cloud computing sector with a reasonable expense ratio of 0.68%. Rather than broadly investing across the entire tech landscape, CLOU concentrates specifically on companies providing cloud infrastructure, platforms, and services. What I appreciate about CLOU is its balanced approach, which includes established cloud leaders and emerging innovators. Companies like Shopify, Twilio, and MongoDB represent the next generation of cloud technology, with revenue growth rates of 20 to 30% annually, substantially outpacing traditional tech firms. According to industry analysts, cloud computing spending is projected to grow from approximately $500 to $70 billion in 2022 to potentially over $1 trillion by 2026, with artificial intelligence applications requiring robust cloud infrastructure. This ETF is positioned at the intersection of two significant technological trends. CLOU offers a modest dividend yield of approximately 0.2%, as most cloud companies reinvest heavily in growth initiatives. Let's shift our focus to another selection. Global X Robotics and Artificial Intelligence ETF with ticker symbol BOTZ. I consider BOTZ my automation accelerator. This ETF focuses on robotics, automation, and artificial intelligence with an expense ratio of 0.68%. Unlike broader tech funds, BOTZ primarily invests in companies developing industrial robotics, healthcare automation, AI software, and autonomous vehicle technology. Key holdings include Intuitive Surgical, pioneering robotic surgery, NVIDIA, leading AI computing, and ABB Ltd, specializing in industrial automation. According to industry projections, the global robotics market is expected to grow at a compound annual rate of 15 to 20% through 2030, while AI computing could expand even faster. BOTZ provides diversified exposure to these converging trends across multiple industries. BOTZ provides a dividend yield of approximately 0.5%, slightly higher than some purely tech-focused ETFs due to its industrial components. Another ETF capturing financial innovation is the Amplified Transformational Data Sharing ETF, which has the ticker symbol BLOK. I view this as the Blockchain Ecosystem Fund. With an expense ratio of 0.71%, this actively managed ETF invests in companies involved in blockchain technology and financial services, cryptocurrency infrastructure, exchanges, and enterprise applications. Being actively managed allows Block to adapt to rapid developments in this evolving sector. Its holdings include companies like Coinbase, Block, formerly Square, and MicroStrategy, organizations helping to reshape financial infrastructure. While many investors focus exclusively on cryptocurrencies themselves, Block provides exposure to the broader ecosystem of businesses building blockchain infrastructure. Block strikes a balance between pure-play blockchain companies and established firms implementing the technology, offering both growth potential and relative stability compared to direct cryptocurrency investments. The fund currently offers a dividend yield of approximately 0.7%, higher than many tech-focused funds due to its financial sector exposure. Now let's move to our next selection, First Trust, Nasdaq Clean Edge Green Energy ETF with ticker symbol QCLN. This fund offers targeted exposure to the renewable energy transition and a competitive expense ratio of 0.58%. Unlike broader ESG funds that include traditional energy companies, QCLN specifically invests in businesses focused on solar, wind, electric vehicles, and energy storage solutions. Key holdings include Tesla, Enphase Energy, and Albemarle Corporation, leaders in the shift from fossil fuels to renewable energy sources. With global climate initiatives accelerating and renewable energy costs increasingly competitive with traditional sources, these companies have substantial growth potential. A standout feature of QCLN is its comprehensive approach to clean energy, which encompasses everything from raw materials to production, installation, and storage, providing exposure across the entire value chain. The fund experienced exceptional performance in 2020 with an 84% return during that year's clean energy boom. While such performance doesn't repeat annually, the long-term outlook for renewable energy remains compelling. QCLN provides a dividend yield of approximately 0.4%, as most clean energy companies prioritize capital expenditures and research over dividend payments. Now, we reach our final selection, which offers excellent growth potential for the coming decade. WisdomTree Cloud Computing Fund with ticker symbol WCLD. This ETF concentrates on cloud software companies with a competitive expense ratio of 0.45%, lower than many specialized sector funds. What distinguishes WCLD is its disciplined selection methodology. It tracks the BVP Nasdaq Emerging Cloud Index, which requires companies to derive the majority of their revenue from cloud-based software subscriptions. This ensures pure exposure to the software as a service revolution. QCLD includes companies like Snowflake, Datadog, and CrowdStrike. Businesses growing revenue at 30 to 50% annually while developing increasingly profitable business models. Their subscription-based revenue provides greater predictability and stability, even amid rapid growth. A notable aspect of WCLD is its performance relative to broader technology indices. Since its inception, it's delivered a cumulative return of approximately 97% through periods of both cloud enthusiasm and sector corrections. Many investors overlook WCLD's focused approach. By concentrating specifically on cloud software rather than including hardware manufacturers or legacy tech companies, it captures the growth potential of one of technology's most dynamic segments. WCLD offers the lowest dividend yield in our lineup at approximately 0.1%, as pure SaaS companies typically reinvest nearly all profits to fuel continued growth. Now that we've explored all 6 ETFs, but before any investment, you should carefully consider several important factors. Number 1 is higher volatility. Expect significantly more price fluctuation compared to broad market indexes. During the 2022 tech sell-off, some of these ETFs experienced drawdowns of 50 to 70% compared to around 20% for the S&P 500. This volatility is the trade-off for potential outperformance. Number 2 is sector concentration. Since these funds focus on specific sectors, they may significantly underperform during periods when those sectors face headwinds. Diversification across multiple themes can help mitigate this risk. Number 3, higher expense ratios. Specialized ETFs generally carry higher fees than broad market index funds. For example, ARKK's 0.75% expense ratio is substantially higher than VOO's 0.03%. These higher costs can impact returns over time. Due to these factors, I recommend a minimum investment horizon of 5 to 7 years for this strategy. This time frame allows you to potentially benefit from long-term growth trends while weathering inevitable short-term volatility. While these ETFs give you broad exposure to innovative sectors, there are 5 specific AI companies poised to explode in 2025 that most investors are completely overlooking. Click the video on your screen now to discover these 5 AI stocks before Wall Street catches on.